Okay. In today's session, we will try to understand the set off and carry forward of losses. This is one of the integral lesson related to tax. It can be particularly relevant in case of income tax and highly relevant for the income from business, income from capital gain, where in addition to the positive income, negative income is also likely to happen. Okay. So some example is that when you have positive income, I mean, when you have not incurred losses, okay, in your income, you are supposed to pay taxes to the government. And when you do not face positive income or when you incur losses, it is likely that you are not supposed to pay taxes on the losses. Okay, but the thing is that uh, government has given benefit to the taxpayers in a way that as a consequence or as a reward kind of, as when taxpayers have positive income or profit, they pay taxes to me. So when my taxpayers will face losses, I will give them some tax advantages so that they can reduce their tax liability. So that is the holistic purpose of the set off and carry forward of losses. The core purpose is that if you can apply these things or these advantages are available in your tax jurisdiction, in that case, you can reduce your tax liability uh, with respect to the losses you have incurred during a particular income year. Okay, so let's say uh, in income from business or profession, you may have income from several businesses. I'm just picking an example of one head income from business. It can be uh, applicable, or you can take similar example in case of other head also. Okay, so for simplicity or for taking understanding it from more real perspective, I am taking the example of income from business, that head. Okay, income from business. Okay, so in your income from business, you may have income from poultry business. You may have income from groceries. You may have income from fisheries. Uh, okay, and there are some. Okay, uh, okay, income from fisheries. Okay, remember, uh, if the things are look like agriculture, like income from field or income from selling crops or income from selling fruits or income from producing tea. Okay, these things are not part of income from business. These things are there are separate rules which are not part of our discussion right now. uh, some portion where you are not doing any processing, you are just producing, you are just growing the crops. In that case, exclusively that will be transferred to the income from agriculture. But in some cases, it requires further industrial processing. Let me give you a very brief example. Think of tea. Okay. There are two parts. One is kind of agricultural part where it requires processing. It requires only the production of the tea leaf in the tea field, okay, or the garden. But the products available after the production is not ready for consumption. It's not consumable. Okay, the tea leaf, the tea leaf, or alternatively, you can think of another example, betel leaf. Okay, so you need some processing here. So that processing is known as industrial processing. So this portion, you can think of a value. So value of a product can be divided into two components. One value is coming from agricultural processing, another portion of value is coming from industrial processing. So the portion which is coming from industrial processing, that will be shown in income from business. Okay. So these are some kind of exclusive example which are available in case of income from agriculture. So in our course, we are not covering income from agriculture. I'm just giving you an example that if the things are kind of income from selling crops, income from uh, producing kind of rice or producing paddy, these things, it will be part of income from agriculture, not income from business. Okay. Okay. So what was our discussion is that let's say in poultry business you have positive income. In groceries, for some reason you have incurred losses, that's why you have incurred negative income. In fisheries you also have uh, negative income. So sorry. So the thing is that uh, what does set of mean? Set of means that you can reduce your positive income from poultry business by charging this loss against this, by charging the loss of which business, grocery business, fisheries business, against the profit of poultry business, so that what will happen, you can reduce your tax liability. You can reduce your taxable income first. Let's say if I give you a numerical example, in poultry business you have 100 million income positive. In grocery business you have incurred 20 million loss. In fisheries, let's say you have incurred 30 million losses. So if you could not adjust these losses against any positive income, what would be your taxable income? 100. But now when set off is applicable, in that case your taxable income will be reduced to 50. So it is very evident that you can reduce your taxable income and tax liability as well. Okay. So that is the purpose of set of losses. Just to I have given you a brief idea or brief example. Okay. So it is just kind of example within the particular head, within, I mean the within the income from business. Okay. But if the thing is like that, say you have income from, you have income from kind of income from house property. Okay. You have income from house property. It should come first according to the chronology of the section. You have income from the house property. You have income from interest on securities. Okay. So the thing is that for the SSC of which we are considering the income, that SSC has income from these three sources. Okay. If it is such that that person has incurred uh, positive income from interest on securities. Usually it should be positive always. Okay, it is positive. Then from income from house property, he has also incurred positive income, but income from business, he has incurred negative income. I mean, he has incurred loss in aggregate in the income from business head. So if you understand the set of within the particular heading, you can understand what do we mean by the set of when we are considering the head separately. Okay, so the loss here in income from business can be set off against the income from interest on securities also. Let's say if I give you a numerical example, income from interest on securities is 100 taka. Income from house property is say 200 taka. And income from business is loss. That's why it is kind of say 50 negative. Okay. So according to rule, what you can do, you can reduce the income from interest on securities by setting off this loss against the positive income of from interest on securities. Okay, so what would happen in that case? Net income from interest on securities, I mean for taxable purpose, it will be reduced to 50. Okay, so what you have done, you have adjusted this loss against the applicable against the positive income of the heading of the sources which according to your guideline. So you probably have noticed already that I have not talked anything about it. Why I am bypassing this positive income and directly hit this positive 100. Okay. So the answer is that there are some guidelines. I will show you it within very few minutes. Loss from income from business cannot be set off against the income from house property. That's why I have not disturbed this. Okay, or I have not touched this, but it is allowable that you can set off the loss from income from business against the income from interest on securities. That's why I have directly come here. Okay, so you have got the concept of set off of loss. Now next thing is carry forward of loss. What do we mean? uh, from the forward term, it implies what it would happen when we consider carry forward. Okay, so let's say I'm taking a simple example. In income from business, our SSC has income from three sources, these particular three sources. Okay, so let's assume that income from business available in our SSC case, the loss is not 50, rather the loss is kind of this amount, 250. Okay, now I'm erasing this so that I get back to the original situation like this. Now income from business for our SSC, loss of 250 for loss of 250 in a particular income year, and income from house property is 200 as it is like previous case, and our SSA has income from interest on securities 100 as it is like previous case. Okay, now as I already have shared one restriction with you, that income loss in case of income from business cannot be set off against the income from house property, and also you can't charge, you can't set off this loss against the kind of income from tobacco manufacturing business, or you cannot uh, set off this loss from income from business against the any capital gain if you have. Okay, I'm just giving you some raw guideline. I'll share the comprehensive one. Uh, okay, a few minutes later. Okay, so can anyone respond that how much loss of this 250 total from income from business can be set off against the positive income available here?
Sir, 100 taka.
100 taka.
100. Okay, so thanks. We have 150 loss remaining to be set off, or we fail to set off this additional 150 loss. Okay, so what does it mean? It means that you couldn't use the full benefit of the loss you have incurred. Why I am telling it benefit? Because this loss has given you the opportunity to reduce the taxable income, that should be considered as benefit. But by this situation, what we are observing right now, you can reduce your positive taxable income by maximum 100 taka. I mean, maximum 100 taka loss can be charged, can be set off uh, based on this consideration, based on the available income and considering the guidelines to be followed by you. So you cannot use the full potentials of the loss to reduce the tax liability. Okay, that so in that case, tax authority has given you the benefit that you can carry forward this loss. You can carry, you can carry forward, not in this way. Which way? The right direction. I mean, you can carry forward. Okay. This loss, which you couldn't set off against the available income, considering the guidelines applicable for you. In that case, the remaining loss which you cannot, which you could not set off, can be forwarded to next or subsequent 6 assessment year. Let's think of the year in which we are right now is 0, or current year is 0. Current year, here we are considering the assessment year. Okay, in the assessment year in which you need to pay tax on this income, I'm considering that assessment year right now is 0. It has been said that this loss can be carried forwarded up to subsequent 6 assessment year, up to 6 assessment years succeeding the assessment year in which the loss originated. You see, this 150 loss is part of which loss? This loss, this loss. This loss incurred in the income year for which you will pay taxes, you would pay taxes in the assessment year, which we are considering for simplicity it is 0. So after that assessment year, in the following 6 assessment year, you can carry forward this loss. What does it mean? It means that, say, in year 1 also you didn't, okay, let me clarify another thing, otherwise you will do mistake here. That is another condition applicable here. Just to give you an example related to here. that is, you have got one condition that subsequent 6 assessment years are maximum number of years you can carry forward loss. Okay. Which loss we are considering right now? Loss from income from business. There is another condition. You can carry forward this loss, okay, fine, to the next 6 assessment year, but you need to set off this loss from income from business against the same business from which you have incurred this loss. Let me give you a real example. Okay, say your business is hotel business, kind of hotel and restaurant. Okay, I'm considering it as a kind of sole proprietorship business. Okay, so you have incurred loss of this amount. You couldn't set off 150 million loss against the available positive 100 million income, so that you are considering to carry forward this loss. So one condition is already available to you, that is you can carry forward this loss up to next 6 assessment year. Okay, fine. But you need to make sure that you are carry forwarding and setting of this remaining loss against, say we are setting off in this assessment year, you need to make sure that your hotel business in this year, I mean the assessment year here, so your hotel business has been running in the income year of which this assessment year is the respective assessment year. If it is like that, you have incurred loss from hotel business in the assessment year 0, there is already an income year with respect to it, right? Okay. So what you have done, say you have closed your hotel business. You have closed down your hotel business. So on the same place, say you have uh, when in the next assessment year or subsequent year, in the same place, say you have begun a new business, which is a cloth business. So you can argue that I have incurred loss from my hotel business and I had been able to set off only 100 million loss against the income from interest on securities in previous year. Now in this assessment year, what I'm trying to do, I'm trying to reduce my positive income from cloth business by setting the loss from hotel business, which I could not set off in the previous year. Have you got the situation?
Yes, sir.
Ji sir.
Your door is closed. You can't do that. So when I have said your door is closed, you can't do that. You need to get the implied condition available here. Don't forget the condition what I already have mentioned. One condition is up to 6 assessment year you can carry forward. So the implied condition here is that what you need to understand that the loss of the business or the business of which you are wanting to carry forward loss that business should be continuing. That business should be continuing. That business cannot be closed. If that business is closed, you can't do that. So the same business of which you need to carry forward the loss, you need to make sure that that business is going on. Okay. So I think you have got the preliminary concept of set off and carry forward of losses. So in this point, what I'll try to share, that is what are the procedures an SSC needs to abide by to enjoy this benefit and to apply these conditions. Okay. So let me share a table with you. This table has been extracted from your text. If you have the text, you can also follow from the text. But I will not read the table for you, as you can read by yourself. Rather, I will try to highlight the procedures on the background of the table so that you can listen to my voice and you can match what has been mentioned in the table. Okay. So I'll try to uh, make the procedures understandable to you. Okay. So first of all, the procedure, the loss generated from one source under a particular head can be set off against the other sources of income, if any, under the same head. So I already have given you the example that within a single head, say income from business, you may have multiple business. So in case of set off of loss, the loss from one business sources can be set off against the profit from the another business sources. Say you have incurred losses from hotel and restaurant business, and you have another business, say you have business of paper and printing business. Okay. So you have incurred profit, or you have generated profit from the paper and printing business. So what can you do? You can charge the loss from hotel and restaurant business. Charge here, I'm meaning the set off. Okay. You can set off the loss from hotel and restaurant business against the profit from which business? Profit from the paper and printing business. Okay. So second procedure, or second point under the procedure, what I try to highlight, if the loss generated from a source cannot be fully set off against the income of other sources in the same head. Okay. In that case, what can you do? You can set off against the income of other heads, uh, providing that you are maintaining or you are complying with the conditions. So say you have uh, income from positive income from paper and printing business, you have incurred loss from hotel and restaurant business, following the previous example. Okay. So say the positive income from paper and printing business is not sufficient enough to set off the loss from hotel and restaurant business. Okay. So think of the previous example, what I written down for you, what I wrote for you. Okay. So still there was 150 loss, uh, say within the income from business. In income from hotel business, you have incurred loss, say 250, and from income from paper and printing business, you have positive income of say 100. so that how much loss is still remaining? 150. So what can you do? You can look at other available head in the same assessment here, in the same assessment here. You can look for other available head. If you see that in other available head, you have positive income against which you can set off this remaining 150 loss. In that case, you can do that. Okay. So that is the point in the number 2 under the procedures to set off. Okay. So let me clarify the explanation in the table. Okay. Income from business or profession. Right now we are pointing out this. Okay. So what has been mentioned here? You can set off the loss of the income from business against any head. Any head means what? Any head means it can be income from salary, it can be income from interest on securities, it can be income from other sources, it can be income from agricultural business, like these things, income from foreign exchange, income from a spouse. Okay, these things. You can immediately observe there are some restriction, except income from house property and income from tobacco products manufacturing and capital gain. Now you recall my words. Have I mentioned any head like this, income from house property, or I have not mentioned this income from house property when I was explaining. Okay, so what you have got, that loss from business income cannot be set off against the income from house property. Okay, then uh, it is not also available that you can set off the loss from business against the positive income from tobacco products manufacturing, and capital gain is also restricted head. Remember, this is not the head of income from tobacco products manufacturing. So you can ask me in which in uh, our northern region of Bangladesh and in our some hill tracts. Okay, there plenty of lands have been devoted for tobacco products manufacturing. Okay, so there are some affluent people are there, some rich farmers are there who have income from tobacco products manufacturing. Okay, so it is uh, restricted that you can set off any loss against the income from tobacco products manufacturing. Okay, you see this income from tobacco products manufacturing thing is common in here in case of setting off loss of salary, and in case of interest on securities it is also here, it is also here, it is also here, and it is automatically restricted here. That's why you are not seeing the mentioning of this income from cigarette or tobacco manufacturing here. Okay, and capital gain is another head which is out of the 10 headings of income. So exclusively capital gain cannot be used to set off the loss of income from business. Okay, so I think you have got it, but what I tried to mention that if your question is in which head income from tobacco products manufacturing is shown, the answer is it is combined process. As you know very well that tobacco leaf cannot be consumed directly. It needs industrial processing. So part of the tobacco income from sale of tobacco, part of this is charged in income from agriculture, and part of the revenue from tobacco products business is charged in the income from business. Okay, say I'm not giving you an example of British American tobacco, the cigarette manufacturing business here, as it has the company structure. Let me give you the example of Kausmia. You have probably have heard about the Kausmia, who is the one of the top individual taxpayers in our country for several decades. He is the sole owner of Hakimpuri Jorda. Okay, so Hakimpuri Jorda is also a tobacco products. So you can think of this example here. Okay, so we are not right now giving you example of setting of loss. Just I am sharing that if you have income from tobacco products, how you will show it in the income tax return. Okay, so if Kausmia wants to show that he has incurred income from selling tobacco products, in that case, the rule is that 60% of the sales revenue will be shown in the income from agriculture heading, and 40% will be shown in the income from business heading. Okay, so let me move on that procedure, the point in the procedure to set of three. Okay, if it is the speculation business, if it is the speculation business, okay, uh, let's say you make a speculation business in the stock market. Okay, so uh, if you have incurred loss in your speculation business, it is restricted to set off the loss from a speculation business to any other heading. Say which heading? Say salary, interest and securities, house property, agriculture income, all are restricted. All doors are closed down, closed off for you. Okay. So you can ask me which door is open for you. The answer is one door is open for you to set off the loss from a speculation business. Which is that door? That door is another speculation business. Say you have two speculation business. One speculation business name, say you have, uh, if I assume that the which business, casino business, say casino. Have you heard about the casino or casino?
Yes, sir.
Which one, casino or casino?
Casino.
Casino. Okay. So look for the casino in the web, that how casino is different from casino. Okay, cash plus casino, these two terms combinedly indicate the casino. Okay, where cash is involved only. Okay, where only cash is involved in playing casino. Okay, so say casino is a kind of speculative business. You have a kind of uh, casino business, and you have another business, say which is a kind of say you speculate in the stock market. Okay, that is another business. Okay, that needs to be more specific. I'm just trying to relate two speculative business. So you have generated loss in case of from casino business. In that case, you can set off this loss against the speculative business which you are maintaining in a stock market only. You cannot set off the loss from speculative business to the positive income of other business which are not speculative in nature. Have you got the point?
Yes, sir.
Okay, okay. So then in capital gain, Uh, the capital gain may not uh, may not be familiar to you, as it involves purchasing capital asset. It involves purchasing capital asset, which requires a good amount of money. Okay, so if you think of uh, uh, our parents are likely not to sell their private land. They are very unlikely to sell their private land even after facing liquidity problem in meeting up the family expenses. It is very likely in most of the families in Bangladesh. Okay, I mean the people who have kind of who have income level in middle class or lower middle class. Okay, you will see that their income level, though they are having lower income level, or sometimes extra expenses in family cannot be met up with the available monthly income, but it is very likely that they have some capital asset, like which is very common, that is residential land like this, or agricultural land like this. Okay, but they are very unlikely, it is very unlikely that they like to sell their land and meet up their expenditure, say for a major surgery uh, for himself or for his son or his spouse. Okay, so the question is why. The answer is that the capital gain tax is involved there. It is possible that you can sell the capital asset at a price which is 2 times, 3 times, 5 times, even 10 times of the purchase price you spend for purchasing the land. Okay, but uh, when you are generating the capital gain, you are supposed to pay the capital gain tax. So to avoid the capital gain tax, people in our country are very unlikely to sell their capital asset. Okay, so that they can avoid the capital gain tax, which is likely to be a good amount. Okay, why I'm saying the good amount? As you have earned the capital gain which is say 6 times of the purchase price or the 5 times of the buy price, so you should naturally expect that the capital gain tax will also be a handsome amount. Okay, so to avoid the capital gain tax, people don't want to realize the capital gain, and people want to look for the other sources to dispose the capital asset and to underestimate their capital gain. Okay, so that they can reduce the capital gain tax. Okay, so there are some land value, for example, in case of land, there are some prices set by the government that in this area this category of land is to be priced at this price. Okay, this is known as kind of area price or a rental price or value is set by the government in some places. Okay, but it has been found that in reality people are transacting their land at 2 times or 3 times or 5 times price. 5 times of what? 5 times of the price set by the government. But people in tax return, they are showing the price which is set by the government, that they are claiming that they have transacted at this value. So in this case, people are getting the opportunity to evade taxes by not disclosing the real value of the transaction. Okay, so that's why in recent years government has withdrawn that the price setting by the government. Okay, so what I'm trying to emphasize here, that is, if you it is very unlikely that you uh, incur the capital gain loss in case of land in our country, but in other capital asset, if it is uh, an SSC incurred loss in his capital asset, what can he do? He can or she can set off the loss from capital gain, sorry, capital gain loss, I mean capital loss, against the capital gain only. He cannot set off the loss from capital gain against other heading. So you can relate it with which one? You can relate it with speculation business. I mean, the rule are same, but the things are not same. Okay. So what does it mean? Loss from a speculation business can be charged against the gain from a speculation business. Capital loss can only be set off against the capital gain. Okay. So then another thing I like to highlight, that is income exempted from tax. So there may be some income of which tax is exempted. Okay. Say there was a rule, I don't know, is it still applicable, that uh, at least in the year 2011 to 2015, most probably, if you construct building in an area other than the divisional cities and the city corporation and the Poroshobha, other than these areas, what I just have mentioned, if you construct building, house property, and you generate income from that house property, say you have uh, constructed a building, you are a sole proprietor, you have constructed a building, say in a remote area, say in a remote area of kind of, where I should mention, say Shirajganj, okay, not in Poroshava, in area. So if you're a sole proprietor and you generate income from that house property for a specific number of years, which is already mentioned in the rule, that you will not have to pay taxes on that house property income. Okay. So if somehow you generate loss from that income source in which tax is exempted, the set off is restricted. So what does it mean? It means that set of facility is not applicable for that kind of income where income is uh, exempted from paying taxes. Okay. So one of you has raised hand. Would you ask your question?
Yes, sir. I would like to ask a question.
Hmm. Amanullah.
Sir,
Hmm.
sir, if
Yeah.
I inherit a land and then I sell this land,
Hmm.
do I is it applicable for the capital gain?
Eh, Yeah, in that case, it is also applicable.
Sir, here I don't buy the land because
Hmm.
I have inherited this land.
Hmm. You have inherited the land, and this is also one way of getting the ownership, but the capital gain tax will be applicable. Okay.
Okay, sir.
So you can look for the rules, that how the purchase price will be determined. Okay. So
Okay,
the
sir.
rule
Thank you, sir.
is kind of in the time of getting the inheritance, what was the price? What was the price available in that time? Okay. So there are some rules that how the purchase price will be determined when the capital asset is owned by an SSC in the mean of inheritance. Okay. Okay. Uh, then what I already have mentioned, uh, you can't set off loss from any of this head what we are discussing against the income from cigarette manufacturing. Now, if the thing is like that, you have the tobacco manufacturing business and you have generated loss from there. Okay. So what can you do? Can you set off that loss from income from cigarette manufacturing or tobacco manufacturing? The answer is that the door is exclusively closed for you. What does it mean? That means you can't set off any loss you have incurred from the manufacturing of tobacco business. Okay. If it is such that uh, you have incurred loss from a particular business, say, and in that particular business, your government has given you some subsidy to reduce your loss burden. Okay, say government right now is providing subsidy or subsidizing the small businesses. Okay, so if subsidy is provided or if any kind of help or assistance in the monetary term is provided to the SSC in the loss making business, the Deputy Commissioner of Taxes will make sure that that cash subsidy has been reduced from the or has been adjusted from the loss so that your loss is actual loss without adjusting for the assistance or subsidy provided by the government. Okay, then you already have seen that income from business is exclusively here. In income from business, it is mentioned that you can't use the income from house property, but you don't see the income from restriction of using the income from house property in any other rows. Okay, so for income from business or profession, you need to keep it in your mind that house property income is restricted. Uh, Capital gain is also restricted. Okay. Then in case of loss, where the say what do I mention the partnership firm. Okay. In case of partnership firm, you know that when the new partner is added to the firm starts its business, uh, not from the existing one, but it has to start its business as a new business or as a new firm. What does it mean? So the meaning is that in partnership firm, the deed is everything. So if any partner is decreased or if any partner is added, in that case, new deed will be formed and the new firm will start its journey. So if it is like that, uh, say the partnership firm has incurred loss in a particular income year. In that case, the loss of the firm can only be set off against the income of the firm. The loss of the firm cannot be set off against the income of individual partners. Have I been able to clear it? In case of partnership firm, the loss of the firm can only be charged or set off against the income or positive income of the firm. It cannot be charged, or it cannot be charged against the income of the individual partners. Okay. So there, these are the things you need to understand from the set of loss perspective. But in case of carry forward of loss, you need to keep some things in relation to the set of. Okay. So before moving to the table which is in front of you, you need to understand some specific rules of the heading which are in which we earn income or from which we earn income. Okay. One we already have mentioned, if it is such that it is the loss from business or you have incurred business loss. Okay. So first condition is that it should not be any speculative business. I'm not writing, remember, it should not be any no speculative business. So what I'm trying to mean here, I'm trying to mean here any business loss which is not from the speculative business. What can be done? It can be set off against the income. It can be set off against the income of the business, and you need to make sure that the business of which you will set off the loss is going on. Okay, it has not been closed. And what you need to do, you need to make sure that you can carry forward this loss up to how many years, how many assessment years?
6 assessment year.
Up to 6 assessment years. So what we are understanding here, we are understanding how to carry forward of business loss. So related to this, I'm just writing that what we have learned in case of set of a set of business loss. We have learned that business loss can be set off against any head except the house property income, tobacco manufacturing, and the capital gain. But in case of carry forward, what we are highlighting that the business loss can only be carry forwarded and set off against that business income of which we are charging or which loss we are carry forwarding. Okay, and that business should be going on, or that business should be continuing, and that loss can be carried forwarded up to 6 years. Remember, these two things are different, though these things are related, but these two things are different. The set of rules are not applicable for carry forward rules are not applicable for set off. So what's the difference you have got? In case of set off, make sure that when we are talking about set off, we are limited within 1 year. We are limited within 1 year. In 1 year, we are looking at the positive income, we are looking at the negative income, and we are looking for the ways how to compensate or how to charge the negative income of some head with the positive income of the other head. Okay, So our perspective is 1 year. But in case of carry forward, our perspective is not 1 year. Our perspective is uh, next 6 years. Next of what? Next of the origin of the loss. Next of the year in which the loss has been originated. Okay. Now, what will happen if the business is a speculation business? If the business is a speculation business, uh, in case of setup, we understood that uh, loss from a speculative business can only be set off against the positive income of another speculative business. But in case of carry forward, what is the rule? The rule is that if you look at the chart, what I was presenting before you, that is, you can carry forward this loss against speculation business only. That means in case of speculation business, you see the rules are same. What rules? The rules for set off of loss and the rule for carry forward of loss. You see, in case of set off, you are permitted only to set off the loss against what? Any other speculation business. And in case of carry forward of loss, in case of carry forward of loss, you are permitted only to carry forward and charged against which income? Only income from a speculation business. Okay. But in case of business or profession, we have seen there are the rules are different. Okay. But the rules for how many years you can carry forward, the rules are same for business, profession, speculation, capital gain, and agriculture income, that up to 6 years you can carry forward the loss. Okay. We'll talk about it later, the remaining two. Okay. Then capital gain. We already have understood that in case of capital gain, the set off can be made against what? In case of capital gain loss, set off can be capital gain. In case of capital gain loss, it can be set off against only capital gain, any other capital gain. This is the set of rule, right? But what about the carry forward, carry forwarding rule? Okay. First rule is that you can only carry forward the capital gain to the next 6 assessment year. That is common always. Okay. But can you carry this loss forward and set off in later assessment year against other heading? The answer is
No,
no.
sir.
You can't do that. You can only set off this loss also in subsequent assessment year against any other capital gain. Okay. Against any other capital gain. Okay. So the thing is that it shall be, I mean, the capital gain shall be set off against income if any of the assets under that head. So that head means which head? The capital gain head. Okay. And accessible for that year. And if we talk about the agricultural business or agricultural income, can you recall the set of rule? Okay. Here, the set of rule is here. Okay. In case of set off of agricultural income, what we have found? We have found that agricultural income can be set off against any heading except capital gain and income from cigarette manufacturing. But in case of carry forwarding, you can't do that. uh, I mean, what you can't do that means what? It means you can't take help of like this any head. It is this thing is applicable in case of set off. In case of carry forward, this is not applicable. We are talking about which income? Agricultural income. So which door is open for you? The door opened for you is only agricultural income. So are you getting a pattern? Is that the set of door is more open, the carry forward door for carry forward is less open? Are you getting a pattern like this? That set off is more open. That means set off is giving the SSA more opportunities to charge the loss and to compensate the income of other heading of positive. Okay, but in case of carry forwarding, you see that in most of the cases only the respective heading are applicable. You see, now this is the carry forward. You see that business or profession, uh, specifically income from same business, same, that means income, say you have incurred loss from hotel business, you cannot carry forward that loss if it is necessary, and you cannot set off against the positive income from cloth business later. You can't do that. You can only carry forward and set off against which business? Against the hotel and restaurant business of which you for which you have incurred loss in previous years. Okay, but you see, uh, in case of set off, the door was more open. In case of set off, you can set off the loss from hotel business first of all against the income from cloth business, and the income from cloth business, if it is not sufficient, you can look for any other available head to set off that loss. Have you got it? Okay, now let me give you an example for partnership firm and the partner. uh, I already have shared the rule for set off, that the loss of firm can only be set off against the income of the firm. So the thing is that in case of partnership firm, you know very well that in case of partnership and the sole proprietorship, there is no difference between the ownership and the firm, or ownership and the business. Both have the single, both have the single, fill in the blank. You're listening? Can anyone fill in the blank? Owners
Sir,
and
we
the
are listening you, but would you please repeat it?
yeah. In case of sole proprietorship and the partnership, both owners and the business have the same
Entity.
thanks. So if your SSC is a firm, say if your SSC is a firm, in that case, the loss of the firm can be set off against only the income of the firm. Okay, but say our SSC is Mr. A. Mr. A is also a partner of say ABC firm. Okay. So ABC firm has incurred some loss, say. Um, for example, think of an amount that they have incurred this loss. Mr. A as an SSC cannot use this loss of the farm, specifically farm loss, to set off his positive income. So what does it mean? Mr. A cannot use the farm loss to set off against his personal income. Okay, the loss should be only set off against the income of the farm. Okay, now if the thing is like that, ABC are the partners of a farm. Okay, you can also look at the example from the text that the ABC has the ownership ratio like this, and also the profit loss sharing this ratio 3:1. Okay, so say right now we are having 2021 income year and 2019-20 income year has already been elapsed. Say in 2019-20 ABC firm incurred loss amounting to say 300,000 taka. Okay, so it is of the previous year. Now in 2021, when it is right now present time, the present income year which is currently going on. So I already have mentioned the loss of the farm can only be set off again and also be carried forwarded against the income of that farm. Okay, it cannot be charged against the income of the individual partner. Okay, so in 2021, the farm has, say, for example, generated 500,000 taka positive income or profit. Okay, but in this time, say Mr. B, Mr. B has left the farm. Okay, say Mr. B has this proportion too. Mr. B has left the farm for whatever the reason. So I already have mentioned when the partners left any firm, new partnership begins and new deed begins. And if new partner enters the firm, new partnership begins, new deed begins. It is the thing happens in partnership firm. So the ABC firm is likely to misuse the rule that if they say that our partnership firm had 300 loss in the previous income year, so we want to carry forward this loss in this year and now want to set off this loss. So in that case, they will try to show that we have now taxable profit of 200,000. So remember, Mr. B has left. Mr. B is no longer in this year. This is a wrongdoing because according to the tax law, the loss applicable for a particular or specific partner cannot be carry forwarded when the partner is no longer with the existing partnership. So remember, the loss of the previous year was 300,000. The loss of the previous year, which is to be carried forwarded, is 300,000. So you see, who has left? Mr. B has left. So can you immediately calculate the proportion of loss which is to be attributable for Mr. B out of this 300,000 taka loss for these three partners? How much loss?
100,000.
100,000.
Okay, fine. So 100,000 loss is to be related to the Mr. B. So in that case, the rule is that the proportion of the deceased partner or the retired partner or the dead partner cannot be used to set off the loss. In that case, how much loss can be set off? You need to subtract this 100,000. 100,000 is of whom proportion? Mr. B. Now, what is the remaining? 200,000 against remaining. So the rule is that it should be 200,000. That means this amount you can set off as long as Mr. A and Mr. C are with the new partnership. Okay. So in that case, what will be the taxable income now?
300,000.
300,000. Now this is the right way. Now consider another situation. Say Mr. ABC has sold their partnership to Mr. XYZ. Mr. ABC, any one of these ABC are no longer with this new partnership. XYZ are three new partners and they have bought the partnership business of Mr. ABC. Okay. So say Mr. XYZ has also generated 500,000 taka net profit in this particular 2021 income year. So they are claiming that we have bought this partnership from ABC partners who incurred loss of 300,000 taka. Now we want to we want to carry forward this loss now in this year, and now we want to set off this loss 300,000. So we want to show that our taxable income is 200,000. So XYZ has done a wrong thing. They are not entitled, they are not eligible to carry the loss which has been incurred by the previous partners. In that case, how much loss they can carry forward? Have you got it?
No
They
loss
can
can
carry
be there.
forward no loss. If it is such that Mr. XYZ has been able to include Mr. A also. In that case, how much loss can be carry forwarded? Only the proportion which can be attributable to Mr. A. Okay. So how much it is?
50,000, sir. 50,000.
150,000.
50, 150. Which one I should take, or the average one?
Sir, 50,000.
50.
Yes, sir.
Mr. A, partner, his proportion is 3 out of this 300,000 taka loss.
Sir, 150, sir.
50, sir, 150.
So how 50 has become 150? Multiplied by 3.
Yes, sir.
Okay. Now, let's talk about an important thing that is different from the discussion what we just had made. But you will see this in the table, that unabsorbed depreciation. You probably have not heard about the term unabsorbed. Okay. So in the text, context you will need to learn about this. Unabsorbed. I think the spelling is not wrong. Okay. Unabsorbed depreciation. Okay. So you are familiar with the depreciation from financial accounting. Okay, that is kind of accounting thing which has no cash flow consequence, right? Depreciation has any cash flow consequence?
No, sir.
No,
It is
sir.
a kind of non-cash expenditure, and finance people loves the depreciation because depreciation, if we exclude the depreciation, we have more cash flows. We have more cash flows, but the accounting people looks at the profit, which can be a lower number if we charges an expenditure, a depreciation expenditure which has not been incurred, which has not been really incurred. Okay, okay. The financial accounting and the tax accounting. I'm just writing the terms in a brief form. Okay. Financial accounting and tax accounting, these two things are different. So you know how financial accounting operates, the standards, applicable standards, and the international accounting standards are applicable here. IFRS applicable. Then in case of tax accounting, other than the standards available here, you need to comply with the tax standards applicable in the jurisdiction in which your entity is going on. Okay, say the company, if I give you example like say a multinational company. This multinational company has business in uh, different countries. So you know well that in different countries, the tax standards are different. So you can immediately recognize the different tax standards will cause different accounting procedures for the same multinational company in different countries. Okay. But the issue what I like to hear mentioned that in financial accounting, you know that say there are MS CRS depreciation rule, modified accelerated cost recovery system, right? Have you heard about it in financial management? Have you heard about it? Modified accelerated cost recovery system, in which high depreciation are charged initially and very low depreciation is charged in the later years.
Yes,
Yes,
sir.
sir.
Okay. And you
Comrade.
also have heard about the standard kind of standalone depreciation policy, then diminishing depreciation, all this. Okay. And other than this, there are some practices. Say if you have a laptop, the standard depreciable life is 3 years. Okay, so these are some financial accounting practices. But in case of tax accounting, the allowable depreciations are different. So how your depreciation will be charged, how you will show depreciation in your accounting, for which accounting? For tax accounting, you need to prepare a separate financial statement, separate statement of comprehensive income. For what purpose? For only for tax purpose. Why you are preparing this? Because the applicable standards are applicable rules are different. That's why you have to prepare it, and you have to pay tax based on which financial statement. The financial statements you have prepared following the tax standard. Okay, so that's why there are differences between the tax calculated here and the tax calculated here. So from this difference, you will see in financial accounting two terms comes in. One is deferred tax asset and deferred tax liabilities. Okay. So we are not going to this discussion now, but the thing is that you need to recognize that the accounting practices are different with respect to tax and the accounting standards. Okay. So the allowable depreciation for the same asset can be different in tax and the accounting standards applicable for you. So say for a particular asset, you are supposed to show depreciation of 100,000. So in that particular year, say profit before depreciation. Profit before depreciation. In tax accounting, there is a rule that you need to check your profit before depreciation. You need to check your profit before depreciation. So if it is like that, say, for example, if it is like that, your profit is 70,000, and if you charge depreciation now in this way, it will cause negative profit to you. Tax authority does not permit this to you. In that case, tax authority says that you can charge depreciation up to that amount of profit which will not lead you to loss. If I charge 70,000 depreciation out of the original depreciation tax authority is permitting me in this particular year out of 100,000, if I charge 70,000, will I incur loss here?
No, sir.
I will not incur loss here. That means how much loss of 100,000, sorry, how much depreciation out of this 100,000 can I absorb in a particular income year uh, with respect to or related to my profit? How much I can absorb? 70,000?
yes, sir.
70,000. How much
70,000.
how much depreciation I can't absorb?
30,000.
30,000. This is the concept of unabsorbed depreciation. Have you got it? Have you got the meaning, concept of unabsorbed depreciation?
স্যার আবার একটু রিপিট করলে ভালো হয়।
Yes.
In tax environment, it is said that you need to look at how much profit is available there before charging depreciation. If it is seen that if you charge the depreciation, it will lead to loss to you. In that case, you need to charge depreciation of that much which will not lead you to loss. So we had in our example 100,000 taka depreciation based on our tax depreciation calculation. But if we charge 100,000 right now, we will incur loss after charging depreciation. So in that case, our allowable depreciation to be charged for tax purpose here will be 70,000. So out of 100,000 depreciation, what we initially planned to charge, we cannot use the remaining 30,000 here for depreciation. In that case, the remaining portion of the depreciation which we cannot show in this particular income year, that is the unabsorbed depreciation. I think you have not missed it this time.
Yes, sir, got it.
Okay. So you see how long you can carry this unabsorbed depreciation to the forward to the subsequent years. So it is not like that you cannot use this depreciation. So one benefit of depreciation is that it reduces your taxes. How? It reduces your taxable income. without incurring any real expenditure. This is the beauty of depreciation. Okay, because it reduces your taxable income and taxes as well, and the amount of tax savings from the depreciation is hefty amount. Okay, so that is not to be underestimated for the tax purposes. Okay, so here how long you will take this unabsorbed depreciation to the future years to set off in future years. Okay, so the horizon is unlimited. The horizon is unlimited. What does it mean? It means that you will continue to forward the unabsorbed depreciation to the subsequent years unless it is completely set off. I mean, for example, up to 10 years, you could not set off this 30,000. In that case, you can still take this for more years to come. Okay. Have you got it?
Yes, sir.
Yes, sir.
Okay. Then there are some income sources in which I already have given example in which tax is exempted. Okay. So if you incur loss in that tax exempted income source, it can only be set off. It can be set off in case of set off. We have learned that income exempted from tax, those sources are not eligible for setting off. But if the tax holiday, have you heard about the tax holiday? Have I mentioned this in class? Tax holiday. In the initial classes, I can recall that I gave some idea that if you set up, say, right now government has taken plan to establish 100 special economic zone across the country. So say one of those special economic zone is the Miroshi economic zone. Okay, so it has given facility to the entrepreneurs that uh, if you set up your industrial undertaking in this area for a specific income year, you will not, for a specific assessment year or for specific years, you will not have to pay taxes. Okay, so for that specific years, what you are doing, you are enjoying the tax holiday. You are enjoying the tax holiday. So if it is such that in the period when you are enjoying the tax holiday, that means you are not supposed to pay taxes when if you incur profit. Uh, so you can also understand that in that tax holiday period, if you incur loss, you cannot set off that loss also. Okay, but the thing is that uh, that loss which you have incurred during the tax holiday, on which tax holiday is applicable. In that case, the loss from the tax holiday undertaking can be carried forwarded and set off against the same undertaking. Okay, uh, let's say you have taken a industrial undertaking to manufacture shoes. Okay, so in the tax holiday, you have incurred loss in the shoes business, in the shoes manufacturing, which is within the uh, setup in which tax holiday is applicable. So after the tax holiday period, uh, you can immediately recognize in tax holiday period, you are not paying taxes, so that there is no question that you will be able to enjoy any tax benefit by showing this loss and reducing your taxable income. This is not applicable here. But when tax holiday is elapsed and you are now in a regular business or you are like other businesses, in that case, what can you do? You can take this loss you incurred during the tax holiday and carry forward this loss here and set off against the income you are earning in during this period. Okay, so these things you need to keep it in your mind, and you will also try to review the procedures. We already have mentioned the procedures in our discussion. uh, uh, you will like to review there are some additional points I'm not mentioning here. These are some additional points like that capital. If you like to carry forward the capital gain losses, that loss uh, must exceed the 5,000 taka, and if it is like that, uh, a business successor in business, that means a person has inherited a business. In that case, he cannot carry forward the loss of the previous business owner. Okay, so we'll try to solve a problem so that we can review what we have discussed so far. Okay, Lina, you want to ask a question? Would you allow me to take your question after finishing the class? I mean, after 15 minutes?
Okay, sir.
Okay. Okay. You see the example, Mr. Jamshed Saudagar reports the following income for the income year ended on June 30, 2019. So our SSC name is Mr. Jamshed Saudagar. Income year is 2018-19, as it is income year ended on June 30, 2019. That's why I am writing the income year 29, 20, 28. It is 20.
80 to 2019,
Yeah.
sir.
Okay. Where it is? Okay. It should be 2018-19. Okay. It should be 2018-19, and assessment year will be the following financial of the assessment income year. That should be 2019-20. So what we are doing, we are trying to make some practice of carry forward of loss. Say the setup is not available here. Uh, just to give you an idea that why we are not doing here setup, or why setup is not relevant here. You see, this person, Mr. Jamshed Saudagar, has income from business, income from house property, income from capital gain, income from a speculative business. Has this person incurred loss from any of the heads?
No, sir.
In that case, setup is not relevant here. Okay. But if we continue to read the question, however, he has some losses carried forward from earlier years, income years, with the following detail. That means he has generated 80,000 taka loss from business or profession income, of which year of origin is 2014-15. Then capital gain 50,000 loss. All these items are loss items. Okay. So uh, uh, this is the problem of carry forwarding. So we need to check that how we can apply the carry forward rules. Okay. So first of all, let me write the income from business and profession, which is the amounting to 500,000 taka. Okay. So in income from business and profession. Okay. How much? 50,000. Sorry, 500,000. Now, we need to check uh, that whether there is any previous year loss in business or profession heading. So if we look at our question, we see that Mr. Jamshed Saudagar incurred loss in income from business and profession amounting taka 80,000. First of all, you need to ask three questions. One question is that income from business or profession, does this person, Mr. Jamshed Saudagar, has income from business and profession in general in this year? So the answer is yes. The Mr. Jamshed Saudagar has income from business and profession. Then another thing, you need to make sure that the Mr. Jamshed Saudagar has incurred this loss from a particular business, not from general business. It's from a particular business. So you need to make sure that that particular business is carrying on by the Mr. Jamshed Saudagar. So there is no other information which indicates that the business from which Mr. Jamshed Saudagar incurred this 80,000 loss is still going on. So we can assume that that business is still going on, and that is implied here. So in that case, what can we do? We have checked the two conditions. The third condition is that this loss was originated or generated in the year of 2014-15, right? So 2014-15, remember, it has been mentioned, it is the income year. These are the income year, okay? So 2014-15. So if 2014 was the origin income year, is it not the 2015-16 assessment year applicable for that income year?
Yes, sir.
Okay, now let's count 6 assessment year following this one. 2016, 17, 17, 18, 18, 19, 19, 20, 20, 21, 21, 22. How many years? How many assessment year?
6 years.
Should I continue more? We should not continue more. We just have written down for understanding. Okay, you should not write it all together. I'm just writing it for understanding. Okay, 6. Okay, you see this assessment year of which you are right now estimating, this assessment year is within this one.
Yes, sir.
In that case, can we carry this loss forward to this assessment year? This
Yes, sir.
okay, so we can write loss. It is kind of carried forwarded from previous year. From it will be very good if you write the income year from which it is coming. Okay, that will provide the reference. Okay, so how much loss we are carry forwarding? 80,000. Okay,
80.
now understand what we are doing here. First thing we are doing here, we are carry forwarding from this year to this year. We are doing here carry forwarding first. Then what we are doing, it looks like set off. But remember, the set of what we understood in the very beginning of our discussion, it is not that set off. What we are doing, we are setting off the loss which has been carried forwarded. But if we talk about only set off, usually it is within a not usually, it is always within the same income year, and it is just crossing the heading. Say you have loss from income from business and you are charging it against the say income from other sources. So okay, but here our first task is to check that whether it is to be can be carry forwarded. Then our task is to set off. Okay, then
Okay,
in
question.
income from in yeah
স্যার এটা তো তারপরে 3টা ইয়ার চলে গেছে ইনকাম ইয়ারের পরে, মাঝখানে ইয়ার গুলাতে এটাকে মানে সেট আপ করছে কিনা এটা কিভাবে এনশিওর করবো? করতেও তো পারে এটা।
Yeah, okay. It has been presented in today's income year or assessment year because it could not be set off.
ওকে স্যার, ঠিক আছে।
Okay. Then you see in the question, there is an unabsorbed depreciation. Unabsorbed depreciation is always related to the business, right? Okay. So the thing is that unabsorbed depreciation, you need to ask two questions. One question is this unabsorbed depreciation is of how much? Why how much is important? Because you need to check how much you can use it. So it is the amount of 50,000. Okay. Now the year of origin is irrelevant here. Can anyone tell me why the year of origin is irrelevant here?
স্যার এটা তো আনলিমিটেড টাইম থাকবে
Oh,
এরকম,
okay,
নট
thanks.
লিমিটেড।
Okay, thanks. Okay, we can write unabsorbed depreciation. Why we are what we are doing here? We are trying to reduce our positive income by including this. Okay, it is of how much? 50,000. So these particulars are specifically related to the income from business. Okay, so 80,000 plus 50,000, it is in total 130,000. So if we write 130,000 and subtract 130,000 from 500,000, we can get 370,000. So can you immediately recognize we have not talked about income from house property, sorry, capital gain, income from a speculative business regarding the carry forward of this loss, because you have already understood that only the income from business and business and profession, this loss can be carry forwarded and charged against the income from business and profession. It cannot be charged against this, right? But income from a speculative business can be carry forwarded against the speculative business only. Capital gain also same. Okay, so that's why we are closing here. Closing for what? Closing for the business and profession. We have closed here. Okay, then we are opening the second one. Which is the second one? Second one is the income from house property. So income from house property. Can you recall what you have seen for the carry forward rule for income from house property? Is there any loss in case of income from house property? There is no loss from income from house property. So you can and there is no room for charging these other losses against the income from house property, because it is very in carry forward loss, you already have recognized that it is very specific. You see that all these are respective heading in carry forwarding, respective, each of these respective. Okay, so we can write down the income from house property, the final amount, which is here 100,000. Okay, the next one, we have the capital gain. So we can see that our SSC has generated loss of 50,000 under the heading of capital gain in previous years, which originated in the year 2009-10, right? Okay, now you need to ask two questions here. One question is in which year it is originated, and whether you have capital gain in this year against which you can carry forward this loss. Okay, we are seeing the capital gain is available in the year in which we are currently calculating. So that capital gain we write first, capital gain 50,000. Capital gain we have written how much? 50,000 we are writing, but capital gain. Okay, you see, we have wrote 50,000. But you see, the loss which we are trying to adjust from the previous year in which it originated, 2009-10. You can look at the chart where it is mentioned that capital gain loss can only be carried forwarded against the capital gain, and maximum limit is 6 succeeding years. Okay, if you calculate the assessment year of this 9-10, it will be 10-11. So after 10-11, if you write down the subsequent assessment year, 11, 12, 12, 13, 13, 14, 14, 15, 15, 16, 16, 17. Now we are where? We are in 1920. So can it be used?
No,
No,
sir.
sir.
In that case, we cannot make this, we cannot carry forward this loss. Okay, I'm just writing here, but you can understand that it is not applicable here. Okay, in that case, what will be the final? 50,000. Okay, now the last one is the income from a speculative business. How much? 80,000. But related to this, you see the speculative business loss available 40,000 from the previous year, the 2011-12. So let me write down the speculative business. Speculative business, how much? 80,000. And now if you count the assessment here applicable for this loss was 1213. If it is the original income year 2011, assessment year applicable for this one was 1213. Okay, so after 1213, can you calculate the assessment year after 1213? Okay, I'm removing this. 6 assessment year following: 17, 18, 18, 19, 13, 14, 14, 15, 15, 16, 16, 17, 17, 18, 18, 19. Okay. Can you use this?
No, sir.
We
Assessment.
cannot use this. We cannot use this because it has already been expired. I mean, the maximum number of assessment year has been expired. Okay, so in that case, what will be the final from a speculative business? It will be, you cannot carry forward. It will be final 80,000. Okay, so in your text you will find that they have included this carry forward of the loss from previous speculative business. There might be some mistake. So to consider that mistake, what can you do? You can change this question, say this 2007-8, instead of considering it 2000, no, not 2007-8, this one 2011, you can write it down 2012 and 2013. In that case, you can touch the assessment year. Is it?
Yes, sir.
Okay. So the thing is like that, it is likely that you will face this kind of mistakes in the text because every year text rules are changed, and every year author tries to change this date. Okay. So sometimes, for example, author has changed this date, but he has not changed this date. Okay, so this is some kind of printing mistake in local text which has not been carefully proofreadden. Okay, so what is your task? Your task is that we have try to solve the problem of example 2. Example 1 is related to the set of, which is related to set of loss of 3 income year together. So you will try to solve the problem by yourself, and will also try to review the procedures of carry forward. You will see that most of the points we have made in we have already discussed in our discussion, so that it's all about set of and carry forward of loss. And your homework before the previous before the next class is to go through the chapter which is tax deducted at source, that is the chapter 14. Chapter 14 of the tax planning and compliance. You will try to read out the chapter by yourself, and we will not cover the chapter in class. Rather, we will try to ask what you have not been made clear from the reading. So we'll try to discuss on those points on which further clarification is needed. Okay, so let me finish the recording for today's class.